The markets are currently closed. October 23, 2025, 4:46 a.m. EST, but the picture from yesterday's close for Bitfarms Limited is stark and, frankly, pretty painful. The stock, trading as BITF, finished the session on the NASDAQ at just $3.94 per share. That was a drop of $0.55 or 12.25% in a single day. For those watching on the Toronto Stock Exchange, the story was identical, a close at $5.52 Canadian, down 12.52%. This wasn't a slow bleed, this was a high-volume capitulation that left a lot of retail traders checking their Robinhood app or Fidelity mobile app in disbelief. The immediate assumption, the expectation for anyone holding a Bitcoin miner is simple: Bitcoin must have collapsed. But it didn't. Bitcoin is still holding its ground, consolidating after its massive 2025 run. So what on earth just happened? The reality is that this 12% crash has very little to do with the price of Bitcoin today, and everything to do with a massive strategic bombshell the company dropped just last week. This isn't random volatility. This is the market trying to price in the fact that Bitfarms just announced it was upsizing a convertible senior note offering from an already large $300 million to a whopping US $500 million. That's the insight you might have missed if you were just watching the charts. A $500 million debt offering is a massive event for a company of this size. These notes, due in 2031, come with a 1.375% interest rate, but the real story is in the conversion. They have an initial conversion price of approximately $6.86 per share. This move is incredibly complex. On one hand, management just secured a massive war chest for general corporate purposes. On the other hand, the market hates two things: debt and dilution. A convertible note carries the risk of both. If the stock rallies past $6.86, those note holders will eventually convert them into common shares, diluting every existing shareholder. That $6.86 mark now acts as a psychological ceiling for many traders. But more importantly, it signals that the company needs a huge amount of capital, and it needs it now. This has completely rattled the common ground belief that Bitfarms is just a simple leveraged play on the crypto market. The reality is that Bitfarms is in the middle of a painful, expensive, and incredibly risky identity crisis, and this $500 million is the fuel for a desperate pivot. Let's look at the pressure that forced this move. The April 2024 Bitcoin halving was not a minor event. It was an extinction-level event for inefficient miners. Before the halving, miners were swimming in relatively easy profits. Post-halving, the block reward was sliced in half. We now have hard data from mid-2025 showing that the weighted average cost to produce a single Bitcoin has ballooned to over $82,000. Some estimates for miners in high-cost U.S. jurisdictions put that number closer to $111,000. With Bitcoin currently trading in the $110,000 to $119,000 range, the margins for pure-play miners have been absolutely crushed. The days of simply plugging in a machine and printing profits are over. Survival now depends on scale, geographic diversification, and, most critically, access to extremely cheap power. This is the reality that Bitfarms management has been staring down. They know that competing long-term as just a Bitcoin miner is a losing proposition, especially against giants like Marathon or Riot, who have secured massive power agreements. This context makes all of Bitfarms' recent jarring moves suddenly make perfect sense. This $500 million raise isn't just to buy more miners, it's to fundamentally change the business. We've seen the proof all year. First, they announced the transformative acquisition of Stronghold Digital Mining. This wasn't just about adding hash rate, it was about acquiring Stronghold's power infrastructure in Pennsylvania. Then, almost immediately, Bitfarms announced the sale of its 200-megawatt Yguazu site in Paraguay. Think about that. They are actively selling off a massive South American asset to rebalance their entire portfolio toward the United States. Why? Because those Pennsylvania sites, which they acquired through Stronghold, are not just for mining. Bitfarms has been explicitly clear that it is evaluating these sites for conversion to high-performance computing and AI data centers. They've already appointed a new senior VP of HPC and a new SVP of infrastructure to lead this charge. This isn't a side project. This is the new direction. They are trying to follow the path of NVIDIA stock's customers, becoming a provider of the raw compute power that the AI industry is desperate for. This is a much more stable long-term business model than being a hostage to Bitcoin's price. But it is also incredibly capital-intensive. Building out AI-grade data centers costs a fortune, and now we know the price tag, at least $500 million. So, this 12% drop yesterday was the market's gut reaction. It's the show-me price. Investors who bought BITF for Bitcoin exposure are selling, confused and angry about the debt and the strategic shift. Traders using platforms like SoFi Invest or Interactive Brokers are recalibrating their risk models. This is no longer a stock you can trade by just watching the price of crypto. This is now a speculative construction and infrastructure play. This also explains the conflicting signals we've seen from institutional owners. Filings from earlier in the year, particularly around Q2, showed a stark divide. Some major funds like Renaissance Technologies and Toroso Investments completely exited or drastically reduced their positions. They saw the margin compression coming and ran. But at the same time, other large players like Invesco and Vidant Advisory increased their holdings. This isn't confusion, it's a clear disagreement on the thesis. One camp believes Bitfarms is a dying miner, and the other believes it's a value play on a successful transition to an AI infrastructure company. Anyone looking for a simple investment will be disappointed. This is high-stakes self-investing in its rawest form, a bet on management's ability to execute an incredibly difficult pivot in a brutally competitive market. Now, a brief look at what the company actually is, for those new to the story. Bitfarms was founded in 2017 and operates as a global Bitcoin mining company. Historically, its whole business model was about vertical integration. They built, owned, and operated their own mining farms, priding themselves on in-house engineering and repair, which gave them an edge on operational uptime. Their operations were geographically diversified across Canada, the United States, Paraguay, and Argentina, with a significant portion of their power coming from long-term, low-cost hydroelectric contracts. This was their key advantage. But as we've discussed, the post-halving reality has changed the game. Their Q2 2025 earnings, reported back in August, already showed the strain. They posted a revenue miss, $77.8 million versus an expected $79.8 million, and were still operating at a net loss. The company is simply not profitable under the new mining economics. This lack of profitability is what makes the $500 million debt raise so necessary and also so frightening. They are funding a massive strategic change from a position of financial weakness, not strength. This is a world away from the relative safety of buying Fidelity ETFs or broad market Fidelity funds. This is the deep end of speculative online investment. This brings us to the future outlook, which is defined by this tension. The expectation many retail investors had that BITF would ride the coattails of Bitcoin's 2025 bull run is dead. The reality is a company fighting for its life, making a $500 million bet to reinvent itself. There are two clear paths forward. The bull case is that this pivot works. The $500 million is enough to successfully convert the Pennsylvania sites into high-demand HPC and AI data centers. They leverage their expertise in managing power and infrastructure to sign lucrative long-term contracts with AI companies, creating a stable, high-margin revenue stream that is completely decoupled from crypto volatility. In this scenario, the mining operations, while less profitable, continue to generate cash flow to support the transition. The stock, currently battered at under $4, would be re-rated by the market as a diversified compute infrastructure play, and it could see multiples far higher than its mining peers. This is the future management is selling. Then there is the bear case. The reality here is that the HPC and AI space is not an easy one to enter. Bitfarms will be competing directly with established data center giants and tech titans who have deeper pockets and long-standing relationships. The $500 million, as huge as it sounds, could be burned through very quickly with construction costs and hardware purchases, like NVIDIA stock's high-end GPUs, without securing a single major customer. In this scenario, Bitfarms is left in the worst of all possible worlds, still burdened with low-margin Bitcoin mining, but now also crushed under the weight of $500 million of debt. The 1.375 coupon still needs to be paid, and if the stock never recovers past the $6.86 conversion price, that debt will remain debt,